Ever heard the saying, what goes up must come down? Well, in the stock market, that's only half the story. The other, more important half is knowing when to get off the ride. We spend so much time obsessing over the perfect moment to buy a stock. We read articles, watch experts, and analyze charts, all searching for that magic entry point. But what if I told you that the real secret to successful investing is UNT, about when you get in, but when you get out? Today, we're flipping the script. We're going to dive deep into why your exit strategy is far more critical than your entry. It asks the difference between locking in life-changing gains and watching your hard-earned money vanish into thin air. Stick around, because mastering this one skill could completely transform your financial future. Let's start with a little thought experiment. Imagine two investors, Alex and Ben. Alex spends weeks researching, finds what he thinks is the perfect, undervalued stock, and buys it at an amazing price. He feels like a genius. The stock starts to climb, and he's feeling great. Ben, on the other hand, buys the same stock a bit later, at a slightly higher price. Not as perfect as Alex's entry, but still a decent move. Now, the stock soars. It doubles in value. Both Alex and Ben are sitting on huge paper profits. They're ecstatic. But then, the market starts to turn. A bit of bad news hits the company, and the stock begins to slide. Alex, still attached to his perfect entry, thinks, it's just a dip, it'll come back. I bought it so cheap, I can afford to wait. He holds on, fueled by the memory of his brilliant decision. Ben, however, has a different approach. He had a plan from the start. His rule was simple. If the stock drops 15% from its peak, he sells. No questions, no emotions. The stock hits his trigger point, and Ben sells, locking in a very handsome profit. What happens next? The bad news gets worse, and the stock continues to plummet, eventually falling below even Alex's perfect entry price. Alex is now at a loss. He's filled with regret, frustration, and confusion. He did everything right at the beginning, so what went wrong? He forgot the most important part of the trade, the exit. Ben, who had a less than perfect entry, walked away a winner. Why? Because his exit strategy was superior. This little story illustrates a powerful truth. A great entry can be completely wiped out by a poor exit, but a disciplined exit can save even a mediocre entry. Your entry point determines your potential profit, but your exit point determines your actual, realized profit. The money isn't really yours until you sell and it's back in your account. Until then, it's just numbers on a screen, susceptible to the wild swings of the market. So why do we neglect our exit strategy? It's all about psychology. Buying is exciting. It's full of hope and optimism. You're purchasing a piece of a company's future. It feels like you're planting a money tree. Selling, on the other hand, is often driven by two very powerful and destructive emotions: fear and greed. Let's talk about greed first. When a stock is shooting for the moon, greed whispers in your ear, don't sell now. It's going to go even higher. You'll miss out on more profits. This is the fear of missing out, or FOMO, in its purest form. It causes us to hold on way too long, riding the wave up and then all the way back down. We watch our massive gains shrink, then disappear, all because we were hoping for just a little bit more. We turn a winning trade into a losing one. Then there's fear. This usually happens when a stock you own starts to fall. Instead of cutting your losses, fear paralyzes you. You think, I can't sell now, and lock in a loss. If I just wait, it will recover. This is called loss aversion. Psychologically, the pain of a loss feels twice as powerful as the pleasure of an equal gain. So we hold on to losing stocks, hoping they'll break even, while they just keep sinking lower and lower, digging a deeper hole in our portfolio. This is why a predefined exit strategy is your greatest weapon. It removes emotion from the equation. It's a set of rules you create for yourself when you are calm and rational. Before the emotional roller coaster of a live trade begins, your plan becomes your co-pilot, making the tough decisions for you based on logic, not on the panic or euphoria of the moment. So, what does a good exit strategy look like? It's not a one-size-fits-all formula, but it generally falls into a few key categories. First, you can set a profit target. Before you even buy the stock, you decide on a price at which you'll be happy to sell and take your profits. For example, you might say, I'm buying this stock at $100. And my goal is to sell it at $150 for a 50% gain. Once it hits $150, you sell. Maybe it goes to $160 or $200 later. Who cares? You met your goal, you made a 50% profit, and you can now move that capital to the next opportunity. A win is a win. Don't let greed for a bigger win turn it into a loss. A more dynamic approach is using a trailing stop loss. This is a brilliant tool that helps you capture upside while protecting your downside. Here's how it works. You set an order to sell a stock if it drops by a certain percentage or dollar amount from its highest price since you bought it. For example, You set a 10% trailing stop. The stock goes from $100 to $120. Your stop loss is now at $108. It climbs to $150. Your stop loss automatically adjusts to $135. If the stock then suddenly drops to $135, your sell order triggers automatically and you walk away with a nice profit. This method allows you to ride the trend up but gives you an automatic ejection seat when the trend reverses. It lets your winners run but cuts them before they turn into losers. Another crucial part of an exit strategy is the classic stop loss for cutting losses. This is your safety net. Before you buy, you decide the maximum amount you're willing to lose on this trade. Maybe it's 8%, maybe it's 10%. If the stock drops to that level, you sell. Period. End of story. It's tough. I know. It feels like admitting you were wrong. But here's the secret. Successful traders are wrong all the time. Their success comes not from being right every time, but from making sure their winning trades are much bigger than their losing trades. By cutting losses quickly, you preserve your capital, which is the fuel for your future investments. A small loss is just a business expense. A catastrophic loss can take you out of the game entirely. Your exit strategy can also be based on fundamentals. Perhaps you bought a stock because the company was growing its revenue at 30% a year. You can decide to sell if that growth rate slows down to 10%. Or maybe you bought it because it had a strong competitive advantage. But a new competitor enters the market and changes the game. Your original reason for buying the stock, your investment thesis, is no longer valid. When the story changes, you should reconsider your position. Don't fall in love with a stock. You are investing in a business, and if the business fundamentals deteriorate, it's a clear signal to exit. Think of it like this. Entering the market is just buying a ticket for a journey. The destination is your financial goal. But along the way, there might be bad weather, engine trouble, or a change of route. Your exit strategy is your map, your GPS, and your emergency plan all in one. It tells you when to stay the course, when to take a different path, and when it's time to get off and wait for the next ride. Without this plan, you're just a passenger, hoping for the best, completely at the mercy of the driver. With a plan, you are in control of your own journey. You decide when and where you get off. The market is filled with uncertainty, but your actions don't have to be. By focusing on your exits, you shift from a hopeful gambler to a strategic operator. You start managing risk instead of just chasing returns. And in the long run, that is the only sustainable way to build wealth in the stock market. So, the next time you're about to click that buy button, pause for a moment. Ask yourself, not just why am I buying this, but also, and more importantly, under what conditions will I sell this? Write it down. Set the alerts. Put the orders in place. Create your exit plan before you enter the trade. It's the most important decision you'll make. Thanks for watching today. If this perspective shift was helpful, give this video a like and hit that subscribe button for more content to make you a smarter investor. Let me know in the comments what your exit strategy looks like. See you in the next video.